Welcome you to the session on amendments in IND AS. May I ask Chetan Kumar to escort CA Mohan R Lavi sir onto the dais. And welcome him with the floral bouquet. Mohan sir needs no introduction, but for formality, Mohan R Lavi is a qualified chartered accountant. He has over 25 years of experience in industry across a variety of industries. He has worked in senior positions in finance, in manufacturing and software companies. Mohan sir also has over 6 years of experience in practice. At present, he is a partner with Messrs. KP Rao and Co. and aids the IND AS and GST practice of the firm. Mohan sir is the author of books on IFRS, IND AS, key audit matters and other relevant topics. Mohan sir has also spoken at various conferences in India and abroad on accounting standards, IFRS, Sarbanes-Oxley's and GST, and is a faculty member with the Institute for their IFRS certification course and registered valuer program. His articles appear frequently in the Hindu Business Line, Deccan Alert, and the Bombay Chartered Accountants Journal. With this brief introduction, I welcome you, sir, and over to you.
So, good evening. Amendments to IND AS. I would like to thank Bangalore branch for inviting me for this program. Actually, first impression was, what do I speak for 2 hours? Because not so many amendments to IND AS has happened over the last 1 year. But thankfully, the International Accounting Standards Board is keeping us very, very busy. Keeping themselves busy first, and thereby after some time they'll keep India also busy. They issued 2 standards recently, one on IFRS 17 and one on IFRS 18. I'll just give you a little bit of a glance of those standards, because IFRS 18 for all of us, which would translate into our IND AS 118 at some point of time, I think that standard is a very critical standard to understand, because it will involve an amendment to Schedule 3 itself of the Companies Act. It will involve amendment to Schedule 3. The format of the financial statements itself will change under IND AS. So Division 2, what you have got now, that would change because of this, IFRS 18. I think probably it will come in some time for the MCA to, come out and give a draft and all those things, all the consultation, all that will have to happen there. But before that, I wanted to just touch base upon one topic which is very, very important. At the same time, it's also a bit of a, I should not say concern, but it's something which is critical from the Indian point of view. As probably many of you here are aware, as we are speaking today, IND AS is applicable to all listed companies, companies with net worth of more than 250 crores, non-banking financial companies, and that's it. Nobody else. 2 sets of industries which are out of IND AS, very surprisingly, are the banks and the insurance companies. For a moment, let's keep the insurance companies apart, because I will be speaking on that new standard in some time. But what is very surprising is NBFCs are into the IND AS network, but banks are still not on the IND AS network, which is really very, very surprising. And I'm quite sure that many of you who are probably doing bank audits would probably understand that RBI was the first regulator to form a committee in 2015 on the impact of IND AS on banks. This committee gave the report in 2015. They did everything. They put formats for P&L account, they put formats for balance sheet, they said what are the impact areas. They said how the bank should also present their financial statements, which should be different from your Schedule 3, because RBI is always going to prescribing that. The committee gave the report, gave some suggestions. After that, nothing has actually really transpired in terms of a notification or in form of any form of a thing from the Reserve Bank of India. But what they did was, again very surprisingly, in 2017, if I'm not wrong, December quarter, RBI told all these banks, you just give me your IND AS figures, don't publish it. Just tell me what the impact is. You just convert to IND AS and you send me the figures. We want data. They wanted data of how IND AS will impact this bank. So all your banks in the country or State Bank of India, everybody sent these information to RBI. Hopefully, I think they sent it because there's no public record of this. What transpired was very clear. Two areas which would impact the banks on their conversion to IND AS, two significant areas, apart from all the other areas of IND AS, are obviously going to be your non-performing assets, provision for non-performing assets, what we call as, what do we call it in bank audit? NPAs we call it. IND AS calls it impairment of financial assets. Wording is different, but the concept is the same. That was one area where there was a significant impact, obviously, because they work on something called as the ECL model and all those things. The other was your treasury income. All their investments had to be marked to market at fair value. So these two areas, obviously I think Reserve Bank of India thought that it will have a significant, you can imagine a bank like State Bank of India, if they value all their investments at market value, what would happen to State Bank of India? See, I think, personally speaking, I feel State Bank of India has got the balance sheet size to take this hit. They have got the size in their balance sheet. But whatever happened, we are not aware of what happened. RBI decided to just keep it quiet. This happened in 2017. 7 years have gone by and still we don't have a official notification as to when banks will transition to IND AS. But we can see that RBI is even today worried about the impact of non-performing assets only. Even today, they gave out a small circular sometime back saying that calculate ECL as per IND AS and just keep the figure, we'll see what happens. Don't publish it, don't account for it. Very slowly, in fact even the latest annual report of RBI, they are saying that we will go for a forward-looking ECL model. We'll go for a forward-looking ECL model. Why this is important for all of you is that anybody who are doing bank audits, and I'm sure quite a few of you will be doing bank audits, this is going to be one significant area of change in the bank audit itself. All of you all, I mean, how many of you are doing bank audits? You can just show of hands. Only one? Okay. Nobody else is doing bank audits, maybe. IND AS has got a very interesting concept. I'll try to push that concept in terms of depreciation, then take the same to bank audit. Useful life of an asset. Who should decide useful life of an asset? IND AS is always of the opinion that, especially IFRS is of the opinion that it is not Ministry of Corporate Affairs, it is not Schedule 3. It is a person who has purchased the asset and is using the asset. And it also says that if you want, you can change the useful life every year. Not just change for the purpose of changing. If you feel that there is a change in the use of the asset, or you are not using the asset more, or asset has got heavily depreciated, you can change the useful life every year. You apply the same logic to non-performing assets, NPAs. Who is the best person to decide NPAs? How much to provide for an NPA? Not Reserve Bank of India. The person who was given the loan. He knows whether the borrower is there, may not be there, will be there, may pay, not pay. He is the person who knows. This forward-looking model of IND AS, or what we call as the expected credit loss model, takes into account this fact and says that don't wait for the loan to turn bad. Make a model depending on how many loans have gone bad in the past. So whether it is State Bank of India, whether it is any of the other banks, there is going to be a significant impact. There will be some impact. I am not saying significant, there will be some impact. So maybe that is the reason why RBI is waiting for a good time for banks to transition to IND AS. But again, there I feel that there is nothing as a good time here, because what IND AS 101 says is that any impact on transition to IND AS you transfer to reserves. It will not impact your P&L account at all. So I do not really understand why RBI is waiting for this, but I can see some small signs of progress here. Apart from this notification on ECL model, a few banks have started asking for tenders for IND AS implementation. Canara Bank has got one, they have appointed somebody, and few other banks have slowly started asking for tenders for IND AS implementation, which means that they seem to be having some information that at some point of time IND AS will be implemented. This is as far as the banks are concerned. So in my opinion, 25 may be a little bit too early, maybe 26 is when banks will transition to IND AS. So one set of people. IRDA did the same thing 2 years after RBI did it for insurance companies. They also formed a committee, they also gave a report, they also said insurance balance sheet should look like this. As all of you know, insurance companies have basically two things. One is insurance balance sheet, one is non-insurance balance sheet, which is your insurance result and non-insurance result. They did all of that stuff. And IRDA almost wanted to announce the fact that IND AS will be implemented after some 2018 or 2019. At that time, what the International Accounting Standards Board was changing this accounting standard insurance completely. What is called IFRS 4 became IFRS 18, 17 now. So IRDA thought that instead of going to old standard, again amending it, let us wait for new standard and announce the new standard completely. So as we are speaking today, there is only an exposure draft of IND AS 117, but even there, it completely changes the way in which insurance companies will account for their income, expenditure, balance sheet also. A little bit I touch upon, I won't get into too much of technical details because we'll still wait for the standard to be announced. Apart from this, of course, members should also know that if you want to voluntarily adopt IND AS, you can still do so. That old MCA notification of 2015 is still valid. Suppose you have got some foreign investor who says, I want IND AS balance sheet, I want IND AS financials and all those things. You can still convert to IND AS voluntarily. The only issue there is, once you convert, you are always an IND AS. You can't say that I don't like IND AS, I will go back to my old AS. That is not there. So this is the applicability of IND AS today. And what the MCA has been doing very frequently, they have also been trying to, keep pace with what the IASB has been doing, though we are still a little bit behind the IASB in terms of, announcing new standards and, giving recommendations on existing standards and all those things. IASB is doing that, that's their job. The IASB's job is only that. So we are simply adopting what the IASB is saying. The Ministry of Corporate Affairs has got a set timetable, or they've got a set pattern. New standard announcements, amendments to existing standards, they will announce only on 31st of March. They will not announce during the year at all. It happened in the IND AS 115, it happened in IND AS 116 also. Both these standards announced only on 31st of March. So every year we will wait till 31st of March, what will MC announce today? So it is possible that 31st March 2025, they may come out with IND AS 117 and also IND AS 118, which is a new standard there. Apart from that, as I told you all, IFRS 17 talks about this insurance contracts and IFRS 18 talks about this presentation of financial statements. Again there, see the IASPs, these people who are in IASP, they have got one task, which is to make financial statements more relevant and reliable. What that means, probably nobody knows. But this is their job. They will give them accounting standard and say that, please make this more relevant and reliable. Unlike countries like India, which has got a time-tested Schedule 3, countries in Europe, Australia do not have a Schedule 3. The only request from the regulator is that you can present the balance sheet in any manner you want, provided you are consistent. For example, a bank can present assets, which will be your loans and advances, as the first item in the balance sheet. A manufacturing company can present property, plant and equipment as the first item in the balance sheet. Unless your industry changes, you have to be consistent. So there is no format there, there is no schedule 3 there. The only requirement is that you have to be consistent, and if you've got any new items there, you will have to probably make a disclosure why those new items have been included there. So as far as most of the geographies abroad, only UK has got some sort of a schedule, but other countries do not have a schedule, or schedule 3, so to speak. The first amendment which the MCA has come out with, and this is a very interesting one, this will involve a little bit of a discussion. I will take your inputs also. Till today, all entities were disclosing what are called as significant accounting policies. IASB said significant accounting policies are too much, there is too much of disclosure. You only ask entities to present material accounting policies. What is the difference between significant and material? Standard does not tell us that. It does not give us any guidance on that. We will have to apply our own judgment out whether anything is significant, whether anything is material, and if it is non-material, we need not present it as an accounting policy. And of course, they have said that it can be reasonably expected to influence decisions that the primary users of statements make on the basis of these financial statements. Now, which comes to a very interesting point, which I am sure that as professionals, all of you will be able to answer this question. Who reads accounting policies? Who reads it? You are an investor in Infosys, I am assuming. Do you read the accounting policies in Infosys? No. Any other company you are invested, you don't read the accounting policies, right? So you are only interested in profit loss account, profit, EPS, dividend, that's all. May not want to look into IND AS, adopted IND AS, that's not your. The criteria for investment is not that at all. Will the bankers look at accounting policies? Bank only looks at debt equity ratio. He'll also be worried about, okay, what is the balance sheet? Is it okay, debt equity ratio is there, it's improving, good, very no problem. Cash flow statement is there, operating cash flow is positive, very good, no problem. So there's a problem here. Who is actually going to read these accounting policies? Because amendment is saying that influence the decisions that the primary users of general purpose financial statements. So on the basis of accounting policies, who is going to make a decision? That population of people is going to be extremely less, if you ask. Going to be very less. Maybe analysts. I probably answer the question first. Maybe all your analysts who are analyzing the company's financials, probably they look at accounting policy. I'm using the word probably here. I'm sure they also don't look at it, but in case they do, they probably look at it. Now we have a problem. Even if you are an analyst, you have seen the Infosys accounting policies, you have seen the TCS accounting policies. There are about 20 accounting policies, let us say. Revenue recognition, all those things. This year, they are going to change it. They may change, I am not saying they are going to change, they may change it. Will it influence your decision making? Again, that analyst I am talking about, not me and you, very, very unlikely. But the idea seems to be, overall, from the IASB point of view, there has always been one criticism about IFRS and thereby IND AS standards also. That criticism is that disclosures are too much. It is impossible to read an IND AS balance sheet and make a decision about the company is good, bad or ugly. It's very difficult because the disclosures are so detailed that by the time you cross 10 pages, you feel it doesn't matter what it is, it's okay, I'll keep my investment. Or for whatever purpose they're reading the financial statements. IASB has always been in this project saying that we want to simplify disclosures. Disclosures, please remember, also includes accounting policies. So from a plain reading of this, I will probably come to the conclusion that if an item in your accounting policy is insignificant, or I should change the word to immaterial, I need not disclose that accounting policy. It is obviously entity specific, it is obviously transaction specific, It obviously depends upon what those transactions or what the net impact of the transaction on the financial statements are. Let me give you an example. Let us take this concept of deferred tax, for example. Let us say your deferred tax is not very significant in proportion to your total tax as also to your total revenue and also to your total balance sheet size. I'll put a number. Last year it was 5% of your total tax. This year it is 8% of your total tax. If I look at this very strictly, I need not present an accounting policy for deferred tax. I am giving deferred tax as an example because anyhow people don't understand deferred tax. All the more reason why if you remove accounting policy also there is no deferred tax. We've had situations where in income tax people have asked me, what is the deferred tax? When are you going to pay it? They asked. So total deferred tax does not result in a payment. Just because the word tax is doesn't mean there is a payment always going to be there. That could be one area where you could have a change in accounting policy because you will say that okay, my deferred tax is not very significant, therefore I am not included in my accounting policy. But this is a notification. You look at these areas, I think I have just given you a hint about what could be, I have just grouped them into, for the purpose of simplicity, to various areas. Other income, for example, could be another area. Interest, royalties, dividend, all those things. If it is very insignificant, again immaterial, you need not present it. My suggestion would be that in case you are doing so, give a small note in the financial statement saying that because of this SCM notification, the company has felt that these accounting policies are immaterial, therefore we are not including in this from this financial year onwards. Now, the next challenge will come up is that in the next financial year, this may become significant. Again, you have to present it. So I think your threshold for materiality should be kept at such a level that you will probably not want to present this at all in the future. That's the only thing you should probably think of. Look at your very high threshold for materiality so that you need not present. I can give you an example. Say for example, Unilever in India, Hindustan Unilever it is called. Their accounting threshold is 100 crores. Their accounting, the threshold for accounting itself is 100 crores. Transaction materiality is 100 crores. Which means that anything below 100 crores in Unilever's balance sheet or P&L account need not be present as an accounting policy. They can use the same threshold and say that I am not going to present at all because not required as per this notification given by the MC. Of course, there will be issues and change of accounting policy. In India, of course, it's not possible, but unless specifically driven by a standard. But this gives you the liberty to not include an accounting policy which you all feel is immaterial. In my mind, the concept of materiality has to be a number. It cannot be based on the accounting policy itself. It has to be what that number is in the financial statements and how that number relates to your overall financial statements. As for example, I give you deferred tax, other income, many of these things. Of course, I need not tell you all that. Say for example, business combination. If you don't have an acquisition, don't account for the accounting policy also. Don't account for the accounting policy at all. You may have acquisition in 1 year, you may not have it in the second year. Not required, don't publish it. Not required to be published because obviously it's not material for that particular year. So basically what this notification has done is that it has given the companies the freedom now, I'll use the word called freedom, to present accounting policies which they feel are probably only material. See, sometimes what we do in India also is that the moment these notifications come from IASB, MCA sometimes is in a hurry, they simply publish it off. They may not take too much of time to understand it, read it. You should not forget that we have not completely gone by a 100% adoption approach, we have gone for a conversion approach in India, which means that we still have the liberty to change what we feel is required. Now in this wording, please understand this wording very, very clearly. First of all, he says that immaterial transactions need not be disclosed. Accounting policy information may nevertheless be material because nature of transactions are there. Not all accounting policy information related to material transactions, other events or conditions is itself material. We've just taken this from IASB and put it here. Now if you read this, your first question will be, what should I do? Should I put it or not put it? Because first of all he said immaterial, don't put it. Then he said it may be material, put it. So what do we do? Can we disclose half an accounting policy? We cannot do that. Correct. But I think the context here appears to be that look at it from an overall point of view. Don't look at it only from a specific, what you can say, transaction point of view. Say for example, deferred tax, you probably want to look at the total income statement, for example, not only taxes which have been paid in that year. So that seems to be the context behind which he is asking for this. Yes, sir. You can sit down, don't sit down.
In GSTR 9C, which is a bit out of context, we have to show that unbilled revenue issues, opening unbilled revenue, closing unbilled revenue. Now, because of this adoption, and that reconciliation is a very cumbersome job, right?
Yeah.
And companies may think that it is immaterial and not start disclosing that, especially it is in the service industry. So then the companies, by not putting that because it is not forming part of my financials, will it be questioned? And they say that it is not there in the financials and I don't disclose in 9C. Then there might be a issue of questions raised.
No, I think it will come with the financials, it will not come as an accounting policy.
No, but some companies, what they do, they don't show under that
Asset side.
asset side or that.
Yeah.
They put it sometimes under the notes to account.
Notes, correct.
So by that camouflaging, will there be an issue?
Sir, I can tell you one thing. One is that, especially since you are saying GSTR 9C, I don't think the GST department understand what unbilled revenue is. So I'll give you that comfort. But having said that, the concept of unbilled revenue is not there in IND AS. You should actually call it as contract asset. You can't call it as unbilled revenue. You call it as contract asset. Because there is a significant difference in this wording. The moment you use unbilled revenue, GST department will say that, oh, this is revenue, somewhere you have to pay tax on it. The moment you say contract asset is your asset, I don't not required. But strictly speaking, if you look at IND AS 115 also, and they don't use the word called unbilled revenue. Many companies are using it, I'm not saying no, but the actual wording should be actually contract asset, because 115, the revenue standard, does not give you the option for calling it as unbilled revenue. The term itself is not used.
Some listed companies are still using that.
They're still using it, I'm saying, that's what I'm saying. No? So,
Unbilled, unearned.
unearned revenue, unbilled revenue, they're saying all these things. But strictly speaking, you should use only as contract asset. But I get your point. My suggestion would be that, see, though it's not related to this topic here, since you raised this question, at least in terms of GST, please have data which will back up those numbers in 9C. Wherever it may be. May not be in accounting policy, may not be in the notes and accounts. You should have data somewhere there. Because we've seen, how the department goes with all this situation. So my suggestion would be, please keep that separately. They are not going to look at 9C, and they are not going to accounting policies. That you don't worry about, but that unearned revenue versus contract asset, that you could be a little bit careful of. In fact, we will be suggesting everybody don't call it as unearned revenue, unbilled revenue, call it as contract asset, because that's what the strict wording is there. But there have been situations wherein for some large audits, they have also questioned about the accounting policies. I'm talking about the central GST, not the city. They have asked for accounting policies because they see the annual report now. See, when they give the annual report, what they have to study it. They have to read it. Whether it's understand all is different issue altogether. That's why I'm saying that if you use the word called revenue, it always rings a bell with them. Use asset, it will not ring a bell with them. But I think on a lateral point, you please ensure that you have those data which backs up your this thing. Okay. Now, we thought, I just told you about 5 minutes back that they want to reduce the disclosures. Now what they are saying, significant assumptions and judgments will still have to be disclosed. If you look at the opening statement of any of these companies' financial statements, they will say significant assumptions and judgments made, revenue recognition they will say, provisions they will say. All these areas we have made significant assumptions, 4 or 5 areas they have probably mentioned. Maybe sometimes even taxes also come into that. That they want to continue. Now the problem or the conflict we are going to have is that if that assumption is immaterial, should I include it or not? For that they use the word called significant, not material. There they have not used the word called as material. Had they used material assumptions judgments, I would have probably said this. I would have probably said yes. But in my opinion, I think that the word significant is only being used out of practice here. I would still say that if those assumptions and judgments which you are making in your financial statements and the number is immaterial, do not include assumption judgments also. Because the standard has to be logically followed. You cannot have one material, you cannot have one significant. So it has to be followed logically to its conclusion. But I am quite sure that if it is not a material assumption you are making, please ensure that it is not there. See, one of the things which happens, and I think this is something which all of you will probably agree with, I am saying this, is that whenever we tell the article clerks, have you made the accounting policy of this company? Or we tell the company also, for the why article clerks, why blame them? The moment you tell the company, have you made accounting policies, what will they do? Huh? One is last year. So where do they get last year's copy? That also some Infosys, Mindtree, L&T, TCS only. See, when IND AS came, everybody was looking at who will publish the accounting policy first. Because we did not have any documentation, we did not have any information about IND AS accounting book. We had IFRS, of course, we had IFRS for a long time. But nothing on IND AS. The moment Wipro came out in 2016, if I am not wrong, 15 December, with a full set of financial statements, including IFRS 9, that document has become like treasure now. Everyone, this is it, we have to start this. I know of companies who do not have financial instrument but have an accounting policy for it. Only because they have said that this is very well written. Beautifully written accounting policy. So we asked the company, do you really have finance element? Let it be, it doesn't matter. So if that is the problem there, what you copy and paste also assumptions and judgments, which will not be applicable in your case at all. One of the things which will happen now in days after this notification has come is that companies will start looking and saying that, okay, I will have to do one time my own accounting policy. My foundation may still be Infosys or Wipro or whatever, my foundation may be there, but I still have to do my own accounting policy. That is one thing which this notification has probably done. Of course, the standard also talks about this and says that if the accounting policy or the area of accounting policy is complex, don't look at materiality, you please publish it. Despite, actually I thought it should be the opposite. If it is complex and not published, you should not publish it. But they are saying if it's complex, but again, thankfully complex has not been defined here. But as I said earlier also, you look at financial instrument standard, what we call as IND AS 109, IND AS 107 and IND AS 32, 3 standards are there. Those set of standards, or especially IND AS 109, it is a lengthy standard, one, requires tremendous amount of concentration, number 2, and third is lot of cross references to paragraphs. The standard does not flow like how PPE flows or how investment property flows or how other standards flow. He will say in paragraph number 8, do this. Then he will say, go back to paragraph number 7, that is do this. So what has happened in 109 is that many companies have started their own way of interpreting the standard, keeping the structure in place. That is, they are not vitiated with the standard. But they have started saying that, okay, this is what the standard is trying to say, because this is what we want to do also. The concept of fair value, amortized cost, all that remains. Which could also be one of the reasons why RBI has delayed IND AS implementation for banks, because as all of you will know, entire bank's balance sheet, 85% comprise only financial instruments. Maybe the RBI is thinking of simplifying the standard or giving simplified measurement norms for banks in particular. But again, may not make much sense because NBFCs have gone to the full blast IND AS without any of these exemptions. So why should they give a separate exemption for banks? Is something we have to worry about. One more beautiful sentence. Immaterial accounting policy should not obscure material accounting policies. I leave it to you to imagine what this could possibly mean. My only request to you all is that in case you are doing accounting policies under this new notification, please don't repeat this sentence, saying that this also is a part of my accounting policy. That is something I should not do. Now again, assumptions, judgments, these also will have to be disclosed, but again, as I said, I will probably go back to my original thought process. And if I look at IND AS always says substance over form, substance over form. What does substance over form mean? If I am using the concept of materiality, I will have to use it throughout. If I have to use the concept of significant, I have to use it throughout. I cannot pick and choose. That's what the concept of substance over form obviously means. So I would still feel that the best way to go about this notification is that look at your accounting policies, number one, put a number to it. Put a number to it. Revenue to total P&L account, to total P&L size. Property, plant and equipment, investment property, total balance sheet size. Put a mathematical number to it. Develop some sort of a high threshold for concept of materiality, and then use that as a basis for saying that these are not material, therefore I am not disclosing. In your 31st March 2024 financial statements, you can make a small disclosure saying that these accounting policies have not been disclosed because as per the notification of the MCA, we have found them to be immaterial. That will take care of all your requirements from this particular purposes. Now, another amendment they made was at IND AS 8. They spoke about this concept called as accounting estimates. Luckily, they have not touched the concept of prior period. They just said that the definition of accounting estimates has been changed to say that monetary items in the financial statements that are subject to measurement uncertainty. So, for example, provisions is a very good example to give. Depreciation itself, useful life itself, as all of you will probably know by now, it is nothing but a change in accounting estimate, not a change in accounting policy. IND AS, throughout, right from IND AS 1 up to IND AS 16, 116, gives you the freedom to make a lot of estimates and judgments. The amendment to the notification still says you still have to disclose it. You still have to disclose it. But the fact remains that the definition has now changed to say that if they are subject to measurement uncertainty, only then you can call it as an estimate. Now, the moment they use the word called as measurement uncertainty, which means that there are possibly more than one measurement possible. For example, useful life. Itself will give you. Even though I have been speaking about useful life, even though there is a notification from the MCA, what does the Schedule 3 say now? Schedule depreciation say now? Useful life shall normally not be different. Now the latest, the schedule now says that useful life shall normally not be different. The previous wording used was, these are indicative useful lives. That has changed now to make that useful life will normally not be different. Indicative useful life means what will you all do? Indicative, no. Doesn't matter. Normally not be different means what? If you are using something differently, you have to justify it. I'll give an example of Dish TV. The set-top box for Dish TV. I think the schedule said 7 years for set-top boxes. Now Dish TV has got data to prove that on an average 75% of their consumers or their customers change their set-top box every 3 years. Either they go to a new set-top box or they go to a new service provider. They don't do Dish TV. So they came out and said that because of this data, useful life cannot be 7 years, it's only 3 years. Because the majority of my customers are changing their set-top box every 3 years. So I have got data to prove this, therefore my useful life is only 3 years and not 7 years. That is still permissible even today under IND AS. Provided you have got data, you have got valuation reports, you have got a technical review who says that this is what the useful life is. I mean, this is slightly different from what we have abroad, because abroad we don't have the schedule as I told you all. You can, depending upon the use of the asset, you can start your depreciation, you can change every year. What are accounting estimates, provisions, depreciation, impairment, all of these things. See, one of the things which probably happened after COVID, again, as all of you will probably be aware, there was a lot of notifications saying COVID impact and all those things. Even today, people are using the excuse of COVID, shall I say. When I'm saying excuse of COVID, we'll say that, why has the borrower not repaid this loan, sir? COVID, sir. The loan itself has got COVID. That's how it is. But what all of you should probably realize is that, again, this is because the standard is there in IND AS, in AS also I'm telling this word called as impairment. In my opinion, this is one standard which has probably not been applied 100%. When I'm saying applied 100%, I mean that from the entity point of view also, they have said that no impairment is there, so don't worry, without actually having to test for impairment. There is enough of data to prove that, especially after this COVID, many industries have suffered from impairment only because of their loss of business, reduced business, whatever it is. The company would always want to delay impairment because they don't, the tax break is still 50-50, they are not getting tax benefit for that. But this puts up a very important question. What is the auditor's responsibility in impairment? Because in accounting standard, both in AS you have got data and you have got this in IND AS also. What is the auditor's responsibility in this? You can ask the company, what will all of you do? You obviously have a checklist. Nowadays, checklists are going to rule the audit. You'll have a checklist for Caro, you have a checklist for companies, you'll have a checklist for the AS, you'll have for IND AS, you'll have for tax audit, you'll have for GST, everything you have a checklist. Look at your Caro checklist. What is the first question in Caro checklist? Does the company have fixed asset register? First question will be a checklist. Who is going to ask this question? To the company? The article clerk. Therefore, also on very complicated Excel sheet. Different color patterns will be there. Red, white, blue, yellow. This is my FIR. The article clerk is so impressed with the sheet, she'll say yes, it is there. Second question. Have the fixed assets been physically verified by the management? Yes, I've got a physical verification report. Only one laptop is missing, that is what you are using. Article clerk is very happy because 2 questions already ticked in 5 minutes. Are the title deeds of the company the name of the company? He'll have a list where they don't have the name of the company, that also is filled. The Caro checklist stops there in most companies. The 4th question should be, have these assets been tested for impairment? It is not there in the checklist. I mean, I'm saying it will not be there in most of the checklists. Because it is not there, that question will never be asked. If that question is never asked, it will never be answered also. So even if you are having an AS checklist for this, please ask this question, have the assets been tested for impairment? We recently had, I can give you this example also. A friend of mine, he had some audit, was using some audit, and I think acquired some land in, I think it is Chennai or somewhere, land or factory somewhere in Chennai. And it was supposedly a factory which was post-COVID closed. This man wanted the factory with land and buildings. So also apparently some machinery was there, which he also wanted to use for his own purposes or whatever. For his, I think they were in the same line of business or whatever it is. So he went to Chennai, struck the deal, paid the money, got this thing registered in his name. The client I'm saying. Did not ask a question, are those machines working? Have they been impaired or not? He paid the consideration for land, building and machinery also. It was a total purchase, but did not ask the question, have those machines been working? After the agreement was executed, after some time they got find most of the machines are not working. In which case this concept of impairment comes in. So therefore, it's very critical that this question of impairment is, because when I said that the standard has not been used very frequently, the reason is very simple. Companies still feel that they can depreciate. They need not impair. They still feel I can use depreciation as a route, don't have to do an impairment. You look at the standard, there are actually two different standards altogether. Depreciation is separate and impairment is separate. You will have to test for impairment. So that's why even in this accounting estimate, what they are saying here is that impairment also is an accounting estimate which has to be made by the management. It is the duty of the auditor to just check that and see whether that estimate made is appropriate or not. So this is something which I thought I should tell you all. Similarly for provisions. Again, we all know this. We are very familiar with the way companies make provisions. You can not worry about the provisions made during the course of the year. What you should worry about is the year-end provisions. The year-end provisions, definition of provision, at least AS 29 is exactly the same. Possible obligation from past event. Definition of a provision is possible obligation from past event. Sorry, current obligation from past event. Possible obligation is contingent liability. Amount is certain, it's a liability. Amount is not certain, it's a provision. Very clear. AS 29 also follows the same language, no changes. On what basis you will make a provision? One is you have an estimate. One is you have got past transactions. You got again past data. You know that this is going to be what it is. You know that this is what the estimate is going to be. You may probably get a quotation from that particular person saying, okay, this is what I'm going to charge you for this. Please remember, it's still only an estimate. It can change. It can change. That is why AS 29 also asks you to give a reconciliation. Opening balance of provision. Provision made during the year. Provision divided into closing balance of provision. That reconciliation has to be provided, both in AS as well as in IND AS, because they know that these things can change. Because it's only an estimate. The definition of, amendment definition of IND AS 8 says that you will also have to make this also is this thing. Small change in the deferred tax provision. If there is no accounting profit, not taxable profit, or both items are the same, there is no need for you to do a deferred tax this thing. First time adoption, of course, there is one small change. The deferred tax for leases and decommissioning costs, because again, for those of you who are familiar with IND AS, you probably realize this, but IND AS 101 is a transition standard. When you want to transition to IND AS, you will have to use IND AS 101 for the first time and for the only time. There they were having this discussion whether we should do deferred tax for example, leases, because leases came later on, after 2015. Now they have clarified and said, yes, when you transition, you should do a deferred tax for leases, because of the fact that operating lease, which is the expense of in your P&L account, will now go and sit in your reserves because of right of use asset and lease liability. Therefore, you will have to do a deferred tax. It's only an amendment for first time adoption of the leasing standard only. Not necessarily 101, because you have probably adopted 101 in the past at some point of time. Okay, this brings me to this new standard on IFRS called as IFRS 18. We will make this a little bit, interactive, so that, again, I'm going to repeat the same questions, but still. Format of balance sheet, Schedule 3. Are you all okay with it? Do you feel it's okay? Or do you feel that some change is required? One is this threat of familiarity. We are so familiar to see this balance sheet that it doesn't okay. It doesn't matter what it is, still okay with me. We just got used to seeing public accounting equipment, all those things here. Why should I even worry about it? It is okay, as long as the balance sheet is standing, I am happy. That's one way of looking at it. The second way to look at it is, does it provide this relevant and reliable information? I told you of this. In IASB, in London, there are 50 people sitting and working on accounting standards. Their job is to make accounting standards more relevant and more reliable. They are paid for that. What will they do? When you go to office at 10 o'clock in the morning, IASB London, what will you do? Your job is only to make accounting standards, IFRS standards more relevant and reliable. What will you do? You will pick up one standard and say that, let me try to change the standard to make it more relevant and reliable. Though I told you all that there is no format for balance sheet and P&L account, in fact for all the financial statements abroad, though I told you all that, IFRS, IAS one always said that one is be consistent, second, present previous year's figures also as per the same format, and third, aggregation of data is your balance sheet, disaggregation your notes and accounts. That you also have to give more information about. So basically, if I got property, plant and equipment in my main balance sheet, aggregation. Disaggregation is your notes and accounts. Whatever acquired in there, all those reconciliations, your PP schedule will be your disaggregation. Now these people said, okay, fine. What should we do now? Balance sheet is there now. Assets column is there, liabilities column is there. That we cannot change. I can swap it. I can say liabilities first, assets first if I want. Makes no sense. Correct? Vertical form, horizontal form, diagonal form doesn't make any sense. So what they decided was, let me do one thing very, very different. We will give presentation of the balance sheet also in a completely different format. So again, this is something which I'm sort of asking all of you. If you want to change the Schedule 3 balance sheet to a different format altogether, what will you think of? See, you have limited choices, okay, because assets are there, asset liabilities are there. You don't have anything else. So this person, I think, or the set of people in London, when they were looking at this, they said, okay, relevant, reliable, I have to change, what do I do? They said, okay, fine. They looked at the next statement. Cash flow statement. I will do one thing. I will link cash flow with my financial statements. Though I am presenting cash flow separately, my P&L account, I will make it as per cash flow statement. One of the changes you will see is that the new revised P&L account is now going to be like a repetition of your cash flow statement. Almost like a repetition of your cash flow statement. Because they always felt that the cash flow statement is probably one of the most, what should I say, underread statements, unread statements, not even underread. For the CFO of a company or the finance manager, whoever it is, what is the first thing he looks for in a cash flow statement? It has to tally. That is the only job. The moment the cash flow tallies, he feels that my job is done. It doesn't matter. He'll put some changes in working capital. Somebody adjusted, definitely not tally, he'll put it in changes in working capital, 100%. Only problem he has to keep a record of various adjusted, because next year I should do the same thing again. No. That problem is there. So cash flow has been matched. He gives it to the CFO. CFO asks him the same question. Cash flow matched? Okay, no problem. Publish it. Nobody actually utilizes the cash flow as a statement for analysis. But if you look at it in a more detailed manner and look at what people have done abroad, and a lot of research has been done, they have got this one concept. They are saying that at a very broad level, very, very broad level, if your operating cash flow is equal to your financing and investing cash flow, or almost equal to your financing and investing cash flow, it appears this company is probably going to be a going concern, not a gone concern. At a very broad level, I am not saying it should match 5 to 5. You can use this ratio and see in any of these balance sheets, this actually turns out to be true. You may have a positive, what you can say, cash flow of, let us say, 10,000 crores in operating. You add, what you can say, financing and investing, it will be around 8,000 crores. Again, it does not have to match 5 to 5 as I said, but at a very, very broad level, this is what they are trying to say. Now these people are not caught out, they say, oh, you know what, we will do this. I will change my P&L account to be a cash flow P&L account. So if you look what they have done here, I'll just give you this thing and then I'll come back to these things. You look at what they have done here, they have said that income statement includes revenue, cost of sales, gross profit, other operating, this is the same basically. They have used a new thing called as Now they have said that profit before financing and income taxes. Then they have said interest expense, profit before income taxes, profit from continuing operations and profit from whatever I call it, discounted operations. The net profit is going to be separate here. So you can see what they have done basically is that change the format to say that, I mean you need not have these line items will be same because it could different, companies could, individual companies could have different things here. This is operating. This is your operating P&L account. Your investing P&L account only includes share of profits on some subsidiaries because you have invested in subsidiary companies and joint ventures. Only that becomes your investing P&L account. Financing P&L account becomes your interest expenditure. Maybe interest income also will come into this. Then you have got income taxes and then you have all the rest continued discontinued operations becomes there. At a very broad level, may not be much of a change from what we are doing today. I only have to categorize my P&L account into these three categories. The individual line components or individual components may not change much. But I will have to utilize it in such a manner that presentation is going to happen like this. Now, obviously, this is only, this has already been released abroad at least as an accounting channel. India will have to see what MCA comes up with. They will probably come up with their own. I don't think they'll change this too much, but they could come up with small changes here and there. The idea behind this again has always been saying that please give information which is relevant. Even today if you look at it, my P&L account may not be as detailed as this particular P&L account, calling it separately investing, calling it separately financing, calling it separately as operating. But the components are still there. The components are still there. I still have share of profit of associates, I still have it in my P&L account separately as line item there. Only thing is, what they have done here is that they have said that you will have to provide for this in this format only. MCA is 100% going to come out with their own format only. Both for banks, NBFCs, banks maybe RBI come out something, but NBFCs and the other companies, scheduled division 1, division 2, definitely MCA is going to come out with this one. For those of you who have got clients who are probably in IND AS, excellent opportunity for you all to actually start charging for some additional fees. Because whatever you are losing as audit fees, you can make up in IND AS 118 implementation fees. Don't tell them it's very simple, don't tell them it's very, very complex. Lot of changes have to be done. You have to change. Now, of course, audit trail, all that is there. You have to change your, entire accounting software, because without help from accounting software, this will not happen. You can't do this off the books. The data should come from an accounting software. The data should come from accounting software. You should be able to capture these things and categorize it. Which is why I've always been saying this. Many people have asked this question. Best accounting software for IND AS is what? SAP, or is it Zoho Books, or is it Oracle Financials? What is it? I've always maintained that best accounting software for IND AS is only Tally. As long as Tally has got this brilliant feature called as Alt-D, it remains on the best accounting packages. You want to shift a voucher? Alt-D over, no problem. Put a new voucher. You want to shift it to financing to investing? Alt-D, put it into this thing. Oh, you're done. In SAP, I've got a very complex process to follow. I should ask for a request. That person may not accept my request. He may not know what financing cash flow is. All these complications come in SAP. So SAP has got its own set of problems. So if your Tally is able to capture this at a group level itself, this transition will become very, very easy. Which brings me to the most important question, which all of you can answer. Do you like this format? Okay, silence means that I don't like it. I'm going to assume that the silence means you don't like it. This may take some time for us to actually get used to. This will take some time for us to get used to, because apparently what they are trying to do is that if you are a shareholder, look only at operating profit. If you are a banker, look at after the financing cost, what is the profit. If you are an analyst, look at the entire P&L account. That appears to be the intention behind it. They are probably doing this because you could get tidbits of information which you can use for the purpose of your analysis. So this is the most important change they made here, and said that, I'll come back to this. They have created two new definitions called as operating profit and profit before financing and income taxes. The concept of EBITDA, which many people use so frequently, now becomes EBITDA, profit before financing and income taxes. You have to use that, the language, the abbreviation will change. People start using this because, please remember that even today EBITDA was not coming from your P&L, it was calculated only. My face of P&L account did not give my EBITDA. It was only giving me the numbers, I had to calculate it separately. This format seems to be making it more convenient for them to say that, okay, if you want to analyze a company in this particular manner, you can analyze in this particular manner. You can use these three categories for the purpose of choosing what you want to look at. One of the things which IASP does, these 50 people in London, is that for everything they give a reason. The reason they have given for this is that company statements of profit and loss account vary considerably. Operating profit is one of the most frequently used subtotals. But companies apply various definitions to the same subtotal because it's not been defined in IFRS account standards. In a sample of 100 companies, 61% operating profit, at least 9 different formula for operating profit is the same. So now he is trying to say that when you look at operating profit, it has been defined. I will show you a little bit later on. Maybe it's come, somewhere here. One of the, many of you have probably seen this, but if you have not seen, please read this. Warren Buffett's annual newsletter to his shareholders of Berkshire Hathaway. It's a very interesting document to read. And every single year for the last at least 8 or 10 years, Warren Buffett has been criticizing accounting standards in US GAAP. When I say criticizing, he is saying that it does not provide the information which I want. It does not provide the information which I want. I want to analyze my investments in a particular manner. It is not permitting me to do so. So what you will see in that newsletter is that he will say that Berkshire Hathaway has $100 million of profit as per US GAAP. Actually, my profit is $150 million. Because I have removed these items from my calculation here. What is called as management performance measures. If Warren Buffett does this in his newsletter, IASB can't keep quiet. So what they've said now is that do it, no problem, but give a reconciliation. What is profit as per IFRS? What is profit as per US GAAP? What is your definition of profit? Please tell me this. And this year, 2024 letter, 2023 I am talking about, December is the year end, he has been a little bit more critical. What he is saying is that net earnings, 90 billion for 21, 23 billion loss for 22 and 96 billion for 23. So what Warren Buffett has done is that he has chosen this 3 years because you can see that obviously 21 there was a profit, 22 there was a loss. Why was there a loss? I gave the reason about 10 minutes back. Blame it on COVID. Okay, there was a loss and 96 billion for 2023. But look at what he is saying now. He is saying that these earnings are promulgated by a sober and credentialed FASB. Correct? Mandated by a dedicated and hard-working SEC. And audited by the world-class professionals at Deloitte and Touche. He has not spared anybody here. Regulator, SEC, auditor also. He has said that. And he says that Deloitte and Touche pulls out no punches, saying, in our opinion, the financial statements present fairly in all material respects. Item is given by Warren Buffett himself. The financial position of the company, whatever it is saying. So what he is saying now is that this is what US GAAP profits are. In the same newsletter, he has said that my profit is 27.6 billion for 2021, 30.9 billion for 2022, and 37.4 billion for 2023. No losses at all. Zero losses. And later on, which are not captured in this presentation here, he says that in my calculation of profit, I have excluded unrealized gains and losses. Warren Buffett has said that until those gains and losses are realized, I will not include it in my accounting at all, or in my calculation for profits. He is giving the explanation here. Over the last 4 or 5 years, he has consistently been saying that accounting standards, especially in US GAAP, will have to change with time because these unrealized gains and losses, which are actually not, what should I say, not realized gains and losses. So his concept is very simple. He is saying that 31st of December 2023, let us say that I made a loss of 5 crores of rupees in my investments. As an investor, Warren Buffett can also include some losses. He may have some losses also. I made a loss of 5 crores of rupees. But this is not a realized loss, unrealized loss. I can always make up for that loss by doing better investments. I can always make up for the loss by doing better investments in the next month or next 2 months, 3 months or whatever it is. In March, I can actually have a profit. I can sell those shares, sell those investments, actually incur a profit and account for that profit. This year he chose unrealized gains and losses. Last year he chose about this intangible assets. Intangible assets, which is again a significant part of the Berkshire Hathaway financial statements, of course. He said once you are impairing it, especially goodwill, you cannot bring it back. US GAAP has got a very strange policy. I mean, India is actually better than that because Indian standard also says that you can revalue intangible assets. US GAAP does not permit revaluation of intangible assets. It is only at cost. So Warren Buffett is saying is that if I have got a new license today for, let us say, 10 crores of rupees, I want to sell it after 3-4 years. I'll obviously get a premium. I'll not be at cost. The premium is my goodwill or whatever intangible asset, our appreciation value is there. When you are asking me to do an impairment, why are you not asking me to do a upliftment also? Both should be equal. So every single year he comes out with this statement and says that this is what are the problems in US GAAP, we will have to rectify these problems. US GAAP, of course, as all of you all know, probably, it is a rule-based accounting standard. It's always been based on rules. Even today it's based on rules. Whereas IFRS, and thereby IND AS, 1973, Mr. G.P. Kapadia had an option for when India went over to accounting standards. He had 2 options. Should I go by US GAAP or should I go by what was international IAS it was called. I think he felt that for India, it is better we go by principles than by rules. Because of a very simple reason. What can happen in a rule? There are 2 problems which can happen in a rule. Especially in accounting. How many rules can you put for transactions? You cannot put so many, you can't put a rule for every transaction. Impossible. You lose track of the number of rules you're going to put. One of the biggest problems in US GAAP has always been that how do you keep track or how do you even give rules which are relevant for those particular industries. One is that. Second is probably more important point is that there is a rule. I break the rule. Who will know about it? There is a rule. I break the rule. Who will know about it? Most of the time, the person who broke the rule only. Not anybody else, because unless I tell you about it, how are you going to make this out? You take companies like Enron, take companies like WorldCon, every single time this is the same problem. The problem is about when do you break a rule, how do you know about it, who is going to actually know about this? So his point has always been that you should make those US GAAP accounting standards relevant to what it is in the current context. If I have got an intangible asset which is actually higher in value, balance sheet as at 31st March 2024 means what? It should reflect the value of assets and liabilities on that date, not unrealized gains and losses. This is what his argument has always been. So I think when you all are having some time, you can look at his newsletters. He always has his own point of view. In fact, as a side point, I can also tell you all this. Many people who go to Warren Buffett for investment, and this has been published in quite a few newspapers also, and quite a few studies also. I believe he does not look at balance sheet. He does not look at P&L account. He only looks at cash flow. And looking at the cash flow, at least what I am told is that he makes an investment decision in exactly 5 minutes. He does not have to think beyond 5 minutes when he looks at the cash flow. Probably he is using the same formula which I am talking about. Operating cash flow is equal to financing or the same cash flow. When the cash flow statement is not actually as per accounting standards, please remember this. Cash flow statement is only got components which are taken from the financial statements. I have got a format for cash flow, I have got what should be my cash flow, what are my components of cash flow. But it does not prescribe, no accounting standard prescribes how a cash flow statement has to be actually prepared apart from format and structure. Which is why when he looks at a cash flow statement, he is very comfortable saying, okay, this is your operating profit, very good. I will probably invest in this company. Now what has happened is because of this change in US GAAP and the change in this, whatever they talk about, this disclosure or presentation of financial statements, he is getting not only a cash flow statement, he is also getting a P&L account. He is getting both there. So his investment decisions will probably be faster because both this information is there. I'll just give you one example just to keep your interest in this Warren Buffett thing. Many of you know that in 2008, Lehman Brothers collapsed. It was a bank in US which collapsed because of all this lending for this mortgage housing and all those things. Lehman Brothers collapsed because they did not do a fair valuation of all those housing loans which they took on from various other banks. But this problem did not happen in 2008. This problem started from 2002 onwards, when the first housing loan was given. The first housing loan was given to a person without adequate finances to repay the loan to a set of people. That's why it's called as mortgage loans. This anyway blew up, and ultimately in 2008, Lehman Brothers did a fair valuation and found that the fair value of those loans is not sufficient to cover their balance sheet. So they suffer. US, very, very strange economy. They will allow a bank to fail. They not allow US, the insurance company to fail. There is a company called as AIG Insurance, Tata AIG, joint venture in India, who are also supposed to fail in US. Because they are the people who had actually insured those houses. Insurance premium was not coming, house loan is not being repaid. AIG was also supposed to collapse because of the same problem. But US government said, no. Bank or government doesn't matter, but insurance company cannot collapse. So AIG went to the US government and said that I will have to apply for bankruptcy, can you help me? US government said that I am also in the same position as you. I also have to apply for bankruptcy. I am not able to do it much longer, but one person can help you. Go and meet him, Warren Buffett. Because he already has an insurance company called Berkshire Hathaway Insurance. If there is anybody in the world who can save you today, it is him. So these people went running to Warren Buffett and said that, sir, I met the US government. They asked me, yeah, I know, I got a call already. So he asked him, how much money do you want? To save yourself from bankruptcy, how much money do you want? They mentioned some figure, some whatever, $1 billion, $1 million, whatever it may be. The figure doesn't matter actually. Normally what Warren Buffett does is that he does not take interest, he takes shares in the company. He says, give me 5% equity shares, 4% equity, whatever he says that. He looked at AIG's cash flow and said that, no, this time I'm going to do something different. I'll not ask for equity shares. He said, based on your cash flow, based on your industry, whatever it may be, you pay me 5% interest every year. Every year you pay me 5% interest. I don't want shares in your company, just pay me. And principal, of course, you have to repay at some point of time. But since you have this problem, we'll decide about the principal later on. AIG were very happy. They said, oh my God, brilliant deal, and no shares to give, 5% you have to pay. So what the CFO of AIG did was, he took 5%, 2 years interest, put it in a separate bank account, State Bank of India, did not touch it, and said 2 years, I have no problem, I will pay my interest. Interest payment came, he went to Warren Buffett, said, sir, first year interest paid, second year interest paid. Third year, not paid. This happened in 2011, when the interest did not come. They went running back to him and told him that, so the small problem is that $90 million of interest you cannot pay. So Warren Buffett asked him, okay, what is your shortfall? How much is your shortfall? About $80 million, he said. Then Warren Buffett said, oh, is that so? Give me your cash flow, he said. Looked at the cash flow statement and found that it was in a worse position than what it was 2 years back. Actually, in worse position than what it was 2 years back. He already had that previous year's cash flow, or 2 years back cash flow. Now he said, okay, listen, I'm going to suggest a few things. Don't pay me the interest. To the extent of interest, please give me equity shares in your company. First thing. Second, please remove your CEO. I've got a new person as CEO, you take him as CEO. And whatever he says, some 4-5 changes. AIG were in such a position to agree to whatever he said. Next day morning, Wall Street opens, Wall Street Journal says that Warren Buffett acquires equity shares in AIG. What happened to the share price? Interest, principal, premium, everything covered in that. All covered in that. Principal also probably got off in that. And what he said was, in one of the interviews he said that this decision was made because the company did not manage its cash flow properly. When I told them I want my cash flows for 2 years, interest for 2 years, they should have managed not only interest, their entire cash flow. It's not only interest, their entire cash flow will probably be managed better. That is why this cash flow becomes a very, very important statement. So anyway, so now what this standard is saying is that, sorry, I'll just come back to this. Yeah. Alternative performance measures or non-GAAP measures. So whether it is Warren Buffett, whoever it is, what IFRS 18 is saying, what IND AS 1 also will say is that if you are using your own metric for calculation of the shareholders, what you call as non-GAAP profits. Non-GAAP means not as per accounting standards. Please give a reconciliation statement. You will have to say profit as per accounting standards this much, profit as per own estimates this much. This, at least in the Indian context, there are very few companies that actually do such a deep analysis of all of these things, because we generally tend to comply with the accounting standards in total. We don't sort of, question any of these accounting standards. But in case you want to choose a different performance metric, this possibility is there. Now again, I can relate to what banks are probably going to do. There are two possibilities now. One is we have got the prudential norms as per the Reserve Bank of India for impairment of assets, which is what is called as IRAC norms. RBI has always been saying that please provide for as per IRAC norms. For NBFCs now they changed to say that please provide as per IND AS 109. But still give a disclosure about your as per IRAC norms, because it is required to be done by some whatever other regulators also. The 2015 report of RBI came out with a very good suggestion for this NPS. The suggestion was like this. They said that minimum provision should be as per your IRAC norms. Use your minimum provision, this should be your base, which means that If my IRAC norm says you have to provide this much, provide that much is the minimum. But if you want to provide more, use the ECL model as per IND AS 109. In my opinion, I think what they will probably do later on is that when the banks transition to place, I will come out with a similar model, I think, and say that use this as the basic norm, but in case you want to provide for more, you can always provide for more as per your IND AS 109. In which case, what will happen? The profit as per IRAC norms and the profit as per accounting standards may be different. What IFRS 18 is saying, what IND AS 109 is saying is that please give one small statement saying that this is what we have to use. Now here, again, I will have to mention this to you all because as many of you have probably worked for or been auditors for or involved in listed companies will know this. They've got these analyst calls in which analysts ask a lot of questions about the performance. Normally every quarter this happens, they ask a lot of questions about company performance, what is the growth plan, why did this change, why did that change, and all those things. And invariably what will happen is that in this IFRS 18, in this IND AS 118, in case we are using a different metric for measuring certain criteria, reconciliation has to be given. The moment you give a reconciliation, more information is given. The moment more information is given, more questions will also be asked. So in a certain manner, what is going to happen is that in case any of these entities use a different metric and give a reconciliation, you are providing for more information, for those people to actually ask you more questions here. But in my opinion, it could be industry specific also. I'll give you another example. Take for example telecom companies. They pay huge amount of spectrum charges to the TRA. The amount is colossal amount of money. Tremendously huge amount of money. IND AS says that, okay, amortization as per useful life, which could be the term of that particular contract, with the contract term, contract period, whatever it can be, right? This is as per what standard says. But in case the Airtel or any of these companies want to use a different metric and say that this is only as per accounting standards, according to me it's much larger than that or much higher than that, they can use it as a separate metric then. So the freedom has been given in IFRS 18 and to be announced IND AS 118, in which they will say that in case you want the shareholders to know a certain metric and you feel that the profits are captured by this metric, please feel free to do so, provided you give a proper and appropriate disclosure. In a single note, you will have to give all of this information, reconciled subtotals and all those things, grouping of information, otherwise known as aggregation, disaggregation. This really has not much changed here, too much of has not changed here. And look at the second last item here. Again, this is something when we have got a different concept in India. How to present or disclose operating expenses by nature or by function. India, we don't have that option. IFRS has that option and says that, as I said, you can, if you are, say for example, oil drilling company, most of your main expenditure will be drilling costs. You can use that separately as a separate metric there and say that drilling cost is part of a paid account. You can present by nature also. Don't have to present to a format, don't have to adhere to a format. That is what this is there. Now, one very interesting thing we should probably have to look at is that, at least in the Indian context, we know this. NBFCs, banks, insurance companies. I can probably bunch NBFCs and insurance and banks together. Insurance companies separately. There will be different formats. There will be different formats because the regulator is obviously different there. But for the other set of companies, will the MCA permit presentation of financials, P&L account by nature of that particular item, or will they stick to a format which is given right now? In my opinion, I don't think they will try to change it too much because we should not forget the fact that the MCA is also extremely wary of preparers of Indian financial statements. Give them a choice, what will they do? They will, choose to do whatever they want to do in this. So MCA will always And this I think again, this is something which all of you will probably agree also, saying that we are comfortable with forms, we are comfortable with formats. If you don't give us a form, if you don't give us a format, we'll have trouble. Because as you were saying, 9C is a format, is a form. We know it now. 3B is a form, we know it now. ITR is a form, we know it now. Balance sheet is a form, we know it now. Suppose I tell you that there is no format for balance sheet required, do whatever you want. I'm just saying. But be consistent. You present balance sheet in any manner you want, P&L account in any manner you want. But be consistent. If I tell you this, what is going to happen? I am not saying you will present wrongly. I am not saying you will present wrongly. But you will think about it and say that, no, maybe this only is better. At least you have got used to this, people have got used to it. I don't know how to, a new format again, explaining all that will probably take a lot of time. So I'm comfortable with this pretty format. So in my opinion, what I think is that MCA may not burn the ocean too much to say, so to say, they will probably stick to this and give us a format, division 1, division 2 only. Division 1 will come for the non-NBFC companies, division 2 will probably come for banks and NBFCs. So I'm assuming that MCA will probably do this in some particular format, and this is what will happen. Schedule 3 will have division 1, division 2. RBI, as I've already discussed a lot, will probably come out of this, and IRD will also come out of this. I will very quickly touch upon insurance contracts before I close, because I do understand that it is 7:35 and ಬರ್ತಾರೆ ಯಾರಾದ್ರೂ ಬರ್ತಾರೆ ಕರೀತಾ 10 ನಿಮಿಷ ಕರೀರಿ 10 ನಿಮಿಷ ಬರ್ತಿದ್ರೆ ಪರವಾಗಿಲ್ಲ ನಾವೇ ಕ್ಲೋಸ್ ಮಾಡೋಣ ಪ್ರಾಬ್ಲಮ್ ಇಲ್ಲ. The IASB has always, when they moved to this International Financial Reporting Standards, IFRS as it's called, US GAAP said, we are very, very powerful. IASB said, look at Enron, balance sheet. How can you be powerful? They said, okay, fine. They accepted defeat. But US GAAP said that, okay, I agree that we are rule-based, we have a problem with all those things. At least going forward, let us develop standards based on some common concepts, common themes, common areas. IASB already had a standard called as IFRS 4 on insurance contracts. Now, as many of you have probably worked or probably been a part of the insurance sector, will probably understand this. Insurance is a slightly tricky business. It requires a specific knowledge of the industry for a very simple reason. My premiums are low, my claims are very high. It can distort my P&L account completely. My premiums may not be paid, I still may have to pay a claim because the policy may still be valid. It's a very, sort of a specific industry. The opening sentence of IFRS 4 is that this is a temporary standard. The opening sentence is that this is a temporary standard. So what people said, especially people in India, temporary, no? Why should you adopt it? Not required. You are accounting for premium received, all that continued as per normal thing only, as per what IRD was doing previously also. That did not change. The only thing which IFRS 4 did, and what we also had the same thing called as IND AS 104 did, was it said that in case your insurance liabilities are found to be insufficient at the end of every year, in effect what they said was, please remeasure your insurance liabilities. They were going back to the concept of fair value and said that if you have paid X amount of claim in the previous year, use it as an estimate and make a provision for insurance claim for the subsequent year also. It did not speak about premium received. It did not speak about anything else. But since it was a temporary standard, people said, doesn't matter, I will do this anyway, IRD is anyway guiding me so properly, so they have no problem. Finally, after almost about 14 years, those 50 people in London came out with IFRS 17, which talks about insurance contracts. I need to tell you all one thing though, which is that, though I said it's a very technical sector, what has happened in insurance today also is that those old insurance policies which we used to take earlier, what used to happen to those insurance policies was that I'll pay a premium, every year I'll pay a premium, policy will continue, event happens, policy is paid out. Plain vanilla annuity policies. Very boring it was. Every year I'll pay a premium, I'll be covered. If the event happens or that whatever event covered happens, policy is paid. Insurance companies became very, very smart. They said that when I am getting 100 crores of premium every year, I am paying 20 crores worth of claims every year. 80 crores is there for me to use. What can I do with these 80 crores? I'll invest it. But investment, as all of us know, many of you are seeing the stock market today, you know what happened. Or following, you know what has happened. Insurance companies became smarter. They said, I will not invest. I will take the policyholder's money. I will tell him on your behalf I am investing. If there is a profit, it is yours. If there is a loss, it is yours. I am only a agent for this. You are only 35 years old now. Why do you want insurance coverage? After 45, you start your coverage. I will invest your money. I will give you bonus every year. Policy coverage will increase. When this was sold to the youngsters, they became extremely happy because they said that brilliant policy. I am not only earning money, but I am also getting my coverage after some point of time. So what happened now? Today's insurance contracts have become financial instruments more than insurance policies, which meant that accounting standards also had to keep pace. Because initially what is happening now is that even though I am covered by insurance technically speaking, I am actually earning money on investment I made in the insurance company. So IFRS 4, the previous standard said that unbundling of insurance contracts, which means that bundle these two things separately, unbundle them. Insurance separately, financing the investment part separately. Investment part, use IND AS 109, insurance part, use IRDA norms. So people were thinking, okay, this is fine. Finally, what happened now? We got IFRS 17 which says that because insurance contracts have now become more financial instruments than plain vanilla insurance contracts, they completely changed the way in which insurance accounting is being done. So, in India today, I think 1st of January 2000 and MCA notification, what we have only the exposure draft there. So, 1st January 23 I think, which means that 31st December 23, last year and starting from 1st January is 31st December. All the insurance companies abroad have already transitioned to IND AS or IFRS 17. In India, we only have an exposure draft. The exposure draft only says that this is only an exposure draft, so we still don't have an accounting standard as in an officially published accounting standard. It will probably come in sometime. IRDA is probably having a look at it. That's what I am saying. Blessings and formats are required from the IRDA, and we require MCA notification. So here, what they have done is that they have gone by the basis of cash flow. I'll just give you only significant parts. I won't take you on to technical detail because this is a standard which requires a lot of technical details. They have gone only by the cash flow, which means that you take a company like LIC. Total amount of cash flow of insurance policies in force. When I am saying cash flow, I am talking about total population of policy holders, total insurance premium received over the contractual life of the insurance period, 5 years, 10 years, 15 years, average, whatever it is. They are saying account for those, take those cash flows. Do a present value of those cash flows. Part 1. Part 2 is what is your total claims? Average of total claims paid. Do a present value of that. So what has happened in IFRS 17 is that it has become a cash flow based accounting for insurance contracts. They are also saying you can include a contractual service margin. I'm just giving you the highlights of this. I'm not getting too much of a technical thing because it still has to be officially notified by this thing. But one thing I can tell you early on is that as an auditor or as a chartered accountant, you will not be able to implement this accounting standard without the help of an actuary. You require an actuary's help for this, assistance for this, because he is the person who will assess your claims, present value of cash flows, all these things. So if you know somebody is an actuary, you can team up with this, will be very, very easy. Also, I think IFRS is very fond of certain concepts. And one of these concepts, they are very fond of this concept called as onerous contract. Onerous contract, already there in AS 29, it's already there in IND AS 37, also now brought into IFRS 17. What is an onerous contract? A contract in which the amount of revenue you are going to earn is lesser than the amount of costs you have to incur to earn that revenue. Onerous contract, that provision has to be made for onerous contracts. They have said that similar concept will come for insurance contracts also, which means that if you have got, see for example LIC, I can tell you, LIC has got a record for the most number of one-time premium policies than any other insurer in the entire world. More than any insurer in the entire world, LIC has got a record for the maximum number of single premium policies. Single premium policy means what? I pay a premium, I am covered. I don't have to pay premium every year. It's a single premium policy. In that single premium policy, what could happen is that you could have lapses. You could have lapses in the premium paid. You could have a very high, sort of bonus. You could have losses in the contract also. All of those things can be there. So IFRS 17 has also recognized the concept of onerous contracts, which means that in a particular set of policies, if the amount of outflow is going to be more than the amount of inflow, IFRS 17 says please provide for those losses instantly, immediately. Don't wait for that event to happen to provide for those losses. So not only have they converted to a cash flow based mechanism for accounting for insurance contracts, they also have presented something called as, I'm just giving you the main parts of it. Onerous contract, discretionary participation features, all these are conceptual terms used in insurance contracts. For example, I told you about this initial investment. Insurance company can come and tell you, I want to invest in Zomato. Will you be a part of this deal or not? You would say Zomato means don't want any other company to tell me I do. Probably you say that, maybe you'll go for it also. We do not know. What I'm saying is that this becomes a very important part of your decision making. So, what could possibly happen is that in this DPM feature, option is given to the policy holder. Do you want to invest or not? Do you want to participate or not? Accounting becomes even more difficult. Accounting becomes even more difficult now, because if I am just covered by insurance policy, I have no problem. I'll follow my normal IFRS 17 requirement. But if there is a DPM feature in which I am getting some returns, here again I have to split the result. One portion will go to my insurance revenue, other portion will go to my investing, my non-insurance revenue, so my investing revenue or whatever the non-finance revenue was in policy. I'll just do this and stop, because I told you I don't have to get into too much of a detail. When the standard came, people always say this in IFRS. Whenever new standards introduced, they always say this. The moment standard comes, what will they say? Very, very complex. Very difficult to implement. Costs are more than what we expected to implement this policy, this standard. So what? When I asked you, these people also thought, okay, fine. If that is your problem, I'll give you a solution. The main income of an insurance company being premium received, I'll give you a permission to allocate your premium for the purpose of recognizing revenue. don't have to, what is called as building law approach is what I told you about this contractual service margin on those things. But if your main business is only, obviously it's going to be premium received, you don't have any investments and all those things, a certain amount of your premium over the life of the insurance contract you can recognize as revenue. It will go back, it will probably go back to the previous way of accounting, where you have always had a premium receipt in the balance sheet. Insurance result is the same. This premium allocation approach can be made only for certain set of policies, not for the entire set of policies. You cannot choose this for all the policies. There are certain requirements here, but I just tell you, I'll take you to the main things over here. Okay, I'm just talking about when is this required? Unless and until your coverage period is 1 year or less, which means that if your coverage period is more than 1 year, you cannot use the PWA approach. You have to go back to the building block approach. Okay, so the only thing which I thought I'll conclude by saying is that insurance contracts by nature are a little bit different from what we know. You may pay a premium for 1 year. You may get transferred. You may not pay for the second year. Policy will probably lapse after some time. You will come back after 3 years. You want to renew the policy. The insurance company will say, okay, you can renew the policy provided you pay for all the back premiums and also probably some charges for whatever, for recovering the policy or whatever. Here we have a problem because there is an amount of modification of the insurance policy. So what this standard is saying is that if the original contract is not valid or it has been cancelled, annulled or extinguished for whatever reason, de-recognize the old thing, think of this as a new policy. Think of this as a new policy. Those are all some of the requirements which are very, very clear from the point of view of this thing. One of the things which IFRS 17 will do, just like how IFRS 15 has done, 116 has done, even in 117 will do this, they will give you a transition provision. The transition provision is going to say that net impact of transitioning to IND AS 117, put it to reserves and surplus or any other component of equity, transition on this particular date, and whatever estimates, judgments or whatever say assumptions you have made, once you transition, you don't have any option. You have to continue this completely. But at the time of first time adoption, since you are going back to your reserves and surplus, touching your reserves and surplus, give that necessary disclosure there. That should take care of this thing here. The last part, which I think all of you should be very wary about also, is that since insurance contracts by nature are spread over a long term, unlike revenue recognition or leases also, leases could probably be over a long term, but unlike revenue recognition, IFRS 17 unfortunately or fortunately introduces a lot of disclosures. There are a lot of disclosures that are required there, both quantitative as well as qualitative. Now again here, even though I told you all that the disclosures are very, very intense as per IND AS and IFRS, in this particular standard, especially in IFRS 17, in my opinion, they are actually required because of two reasons. One is the industry is such, and second is the transactions in the industry. The transactions in the particular industry, considering the fact that they have got financial instruments and all those things, those also are a little bit complex. Therefore, these disclosures are actually very, very much required, especially for a person who is reading an insurance contract balance sheet for the first time. It is going to take time. It will obviously take a lot of time because IFRS is saying it's already been introduced, but India is still not very clear. But whenever it comes, you have a transition provision of 2 years. 2 years means third year only you have to implement it. So I thought this is what I have to say. So this is how your statement of profit and loss will look at in a insurance company. You'll have insurance revenue, you'll have insurance service expenses, you'll have investment income, you'll have insurance finance expenses. These are only from the standard itself, so no, a lot of companies like Alliance and all already published their balance sheets as per IFRS 17, but I'm just giving you the format. Thank you very much for a very patient hearing. Thank you very much. So,
Thank you, sir, for that knowledge enriching session. May I request CP Jain to hand over a memento as a token of appreciation to the Bangalore branch of ICI. Thank you, sir. This is a small announcement. I hope you are aware of the startup fair, which is going to happen on 27, 28 and 29th of June. It is in KPTO, Whitefield. If you have not registered, please do register. Thank you.